One particularly contentious and central aspect of economics is the property market, especially as one's home is usually the largest single asset accrued in an individual's working life. It is also a quandary, as it is the asset of last refuge, in that it is the most essential expenditure most of us will ever make and the last thing we will default upon in the event of hardship. It is also a primary asset against which to borrow, as well as being one which most of us can rarely ever acquire in a single transaction, even buy-to-let landlords. The property market has also been beset by complex financial packages, which are themselves bundled into complex financial assets such as CDOs, which were the root cause of the last financial crisis. Many economists have predicted a sharp fall in property prices, which former trader turned pop economist Gary Stevenson has flatly refuted, largely on the grounds that the wealthy classes will continue to acquire property as cash-generating assets, despite recent increases in interest rates. During the aftermath of the COVID crisis, Gary stated,
The Guardian, saying house prices are going to go up. At the same time, Larry Elliott, chief economics correspondent of The Guardian, wrote an article, and we'll link it in the description so you can see, saying house prices are going to collapse later this year. So why was it that I was then able to make this correct prediction when basically everybody else was predicting a house price crash? It didn't happen.
While it is true that property prices are very sticky in that they are the last to decline when all else before them have fallen, it is also true to state that when the currency is printed en masse and made available at low interest rates to the rich, that cash-generating assets such as stocks, shares, and property tend to become inflated above a rational market price. Despite interest rates surging, which is important for bad debts to be shaken out of the economy via mortgage defaults and repossessions, Gary has nonetheless doubled down on his previous statement that property prices will continue to rise and rise.
That moves us into this new situation, which is economists and traders have this very strong belief that when interest rates go up, asset prices and house prices should fall. And that is for a very understandable reason, which is in the case of house prices, people can't get a mortgage if interest rates are super high. And lots of you will have witnessed that it's much more difficult to get a mortgage when interest rates go up. You know, in many cases, the same people who predicted a house price crash at the beginning of COVID came back and said, okay, well now we're definitely going to get a house price crash now, because not only have we got this terrible economy, but we've also got really high interest rates. But what actually happened was that, basically house prices, they sort of stumbled a little bit, but I think the broad picture of house prices, it depends where you look, is they rose super quickly, sort of 30% or so in 2 years. And then since then, they've kind of maybe stumbled down.
Despite the persistence of higher interest rates, Gary remains unflappable that property prices will continue to rise.
5-6%-ish. And it was during this rapid rise in interest rates that I gave my interview with Aaron Bastani on Navarre Media, which you can find on YouTube. That was when interest rates had just started to rise really quickly. And then everybody was saying house prices are definitely going to fall. And I came out and said, no, I think house prices will actually, in the long run, continue to rise. And
this contention seems to fly in the face of previous property cycles and also overlooks what Ray Dalio calls the convergence of long and short-term cycles as excessive borrowing, spending debt, and cultural and economic decline all coincide to cause a crisis in the confidence in the economy and currency. In simple terms, while residential properties are the last line of default for most of us, as interest rates remain elevated, so mortgage repayments increase, forcing landlords to increase rents and the percentage that most of us spend as a proportion of our incomes on accommodation to rise in lockstep. However, this means that, as wages stagnate and inflation affects most essential everyday purchases, we have less discretionary spending to outlay on non-essential services such as salons and spas, less to spend on eating out, less to spend on entertainments such as cinemas and clubs, and less to spend on traveling and holidays. We also have less to splash out on non-essential goods like toys and fashions. This means that there will be mass layoffs in the retail and service sectors, which means fewer people who will be able to afford higher rents, leading to less spending in the economy, culminating in a vicious recessionary cycle. Something will have to give, and buy-to-let landlords, already hand-tied by the end of no-fault evictions, will seek to sell up as their returns are no longer worth their capital outlay. Mortgage defaulters will return their keys to the banks, and cash-strapped renters will resort to sharing homes rather than having places of their own. The banks will find that their balance sheets are overloaded by bad loans on properties, in addition to the wave of bad loans that were made on largely vacant office properties. The banks will thus be forced to have a fire sale to clear their balance sheets, and many will simply not be able to sit on unsold and overpriced houses. Look for a property crash of between 25 and 40% by the fall of 2025 in the UK.